Thanks, Chad, and thanks to all of you for being here today. If at the time that Dodd-Frank was being worked on, you had said to the framers of the act, do you think it'll be necessary 3 years into implementation to do a survey to find out how small banks are doing? They would have said absolutely not. This is not a law about small banks. It's a law about the big banks that were at the center of the crisis. Those are the banks that we're trying to regulate more. In fact, they took steps to try to shield small banks from some of the ramifications of the law. They put in certain exemptions in the law to do that. And they did that because they understood the value that small banks play in our financial landscape, which is a very diverse financial landscape. We've got lots of small banks, medium-sized banks, and big banks, and they all serve different functions, all of which are valuable. And Congress presumably was thinking of that when they were putting in these exemptions in the law. So small banks serve small rural communities, small metropolitan areas, and other communities that frankly large banks are not that interested in serving. So they serve a valuable function there. They're also a big source of small business lending, and so that's a very important role that they play. And they are also able, because they know their communities so well and they get to know their customers so well, they're able to provide financial services to people who might not be able to get them from a large bank bound by a model-based lending approach that's based on plain vanilla standards. So small banks are very important, and people recognize this. But you can also see that over time, the assets in the banking industry have shifted from the small banks to the larger banks, and we've seen a real decline in the number of small banks. And of course, this predates Dodd-Frank. But there are questions about the role that regulation has played in causing this change in the banking landscape. It's much harder for a small bank to absorb regulatory costs than it is for a large bank. And so, especially after Dodd-Frank, there have been a lot of questions about the role that regulation is playing in this consolidation. And so in addition to the anecdotes, which I'm sure all of you have heard lots of about the pain that small banks are suffering, we've got some empirical work to back that up, and we thought that there was room to do more empirical work. We wanted to do a large-scale survey of small banks that was very detailed and asking lots of questions about Dodd-Frank specifically, and so that's what we set out to do. And we thought that because we're a university-based research center, we would maybe get more candid answers than a regulator holding a roundtable and asking banks to speak and say what's bothering them. So we hoped that we could get more candid responses, and then we also conducted it anonymously over the internet, and so again, hoping that we would be able to get honest answers from folks about what they're really experiencing. And we were able to get about 200 banks to participate in the survey. We're very grateful to them for their participation. We know that they could have been doing lots of other things, like reading the Federal Register with its scintillating new regulations. But instead, they helped us to paint a better picture of what banks are experiencing under Dodd-Frank. And as it turns out, small banks really are feeling the weight of Dodd-Frank. They've not skated under it as maybe some people thought that they would. Their compliance costs are going up, and they're also seeing that their managers and their non-compliance personnel are spending a lot more time working on compliance issues. And that's a big problem in a bank with a small staff if people's time is being diverted to spend on regulatory issues. And then, of course, they're hiring more compliance people. And so you might say, okay, big deal. You've got a small bank with one compliance person, and now they have two. So why should we care? I mean, after all, this week, the Wall Street Journal reported that J.P. Morgan is hiring 3,000 new compliance people this year, and compliance, probably regulatory and legal people as well. And they hired thousands last year too. So in comparison, what do we care if a small bank is having to hire an additional person? So I think you have to put yourself in the shoes of the small bank, which maybe is located in a rural community, has about 50 employees. And so hiring one compliance person is going to be a big addition to its expenses, especially because compliance people probably have to be fairly skilled and have a fair amount of education. And so not only is it the expense, but it's also the concern about how are you going to find someone in a rural community who has those skills? And it's a very difficult challenge for small bankers. We heard in the survey lots of concerns about mortgage regulations specifically and about the new Bureau of Consumer Financial Protection, which again, Dodd-Frank did try to give small banks some protection from the CFPB, but they're feeling very much under the thumb of that new regulatory agency. And then the other issue that we noted in the survey was that banks are thinking about how to respond by rethinking whether they want to offer products and services. Is the regulatory cost of what they're offering too high, and should they just stop? And often banks offer products and services not because they're making lots of profit from it, but because they know it's useful to their customers and they want to maintain that relationship with their customers. And we're also seeing that banks are sort of trending towards consolidating with one another, because if they can consolidate, they can spread the compliance expenses over a larger asset base. Going forward, what do we expect? We expect to see the consolidation trend pick up, and we expect, based upon what the banks told us, we expect that the consumers will actually not be better off. So the banks said, obviously, we're going to have to pass on our costs to the customers. And we're going to have to spend less time dealing with customers one-on-one the way we like to do, because we're spending too much time on regulatory compliance. And more than that, they feel that the customers are not getting the benefit that Dodd-Frank was intended to give them, which is more consumer protection benefits. They said it's almost embarrassing for them to have to go and present this big stack of new papers that they have to have the customers look at because it's a regulatory checklist. And so they feel that their relationship with their customer has become very unnatural, because now it's all driven by regulation. Ian is going to go ahead and present us some more color and walk us through some of the specific results.
Thank you all for being here, taking the time out of your day to come and hear us present. And as Hester said, I just want to express my gratitude to the small banks who participated in the survey. We're really grateful for all of them, the time that they took to participate. What I'm going to do is walk through a little more than a dozen slides to help visualize the results of the survey. This is going to be a very quick flyover, but I encourage you all to take a look at the full paper. And please note that the numbers and the chart titles reflect those in the paper. They're not necessarily, we didn't renumber them for the slide. So if you see strange numbers or jumping around or out of order, it's to reflect the charts as they're presented in the paper. So what I'm going to do is I'm going to cover some characteristics of the banks that were in the sample, show a couple slides regarding compliance costs, and touch on the major concerns, namely the CFPB and the new mortgage rules. And then talk about small banks' response in this consolidation trend that we see. This is a slide that presents the distribution of the survey sample versus the population of small banks across asset classes. And you'll note that it matches pretty well to the blue bars in the survey sample match pretty closely to those of the overall small bank population, with a little bit of underrepresentation in that $10 to $100 million category. Most small banks in our survey describe themselves as local, either that or regional, but within a single state, roughly 95%. They're also largely serving rural populations or small metropolitan areas. And as you can see, they were able to select multiple answers, but the most common response was that they were serving moderate income populations and communities. Here we asked what the change in annual compliance costs have been since Dodd-Frank. And as you can see, the overwhelming majority said that compliance costs had increased, with 83% roughly saying that it had increased by more than 5%. Of course, what it doesn't tell you is, for those who said that it had increased by more than 5%, what the upper threshold was. So that could be 10%, that could be 50%. We don't know the specifics, but as Mr. Trabajo will point out, the increase in compliance costs over the last couple of years has been very significant. Here, we asked them the number of compliance personnel before and after Dodd-Frank to give a little bit of a snapshot. And as you can see, the distribution, the blue bars being before Dodd-Frank and the orange bars being current number of compliance personnel, that distribution has shifted to the right. And as Hester pointed out earlier, the shift from a median of 1 to 2 and an average number of compliance personnel from 2 to 3, you have to put it in the context of how big these banks are. Median number of total personnel was around 50, so adding 1 additional compliance personnel where that doesn't contribute anything to the top or bottom line of the bank is a significant cost increase. The other issue that we have to keep in mind is that the Dodd-Frank rulemakings are only halfway through. So if this trend continues, what will the long-term cost be? And also note that adding full-time compliance personnel is not the first option for most banks. They increase the compliance activities of non-compliance personnel. They try and get the most horsepower that they can out of their existing employees. So going and hiring additional compliance personnel is not their first move. Here, as just a baseline, we asked them how they would rate the Dodd-Frank rulemakings in comparison to the Bank Secrecy Act, which is pretty widely regarded by the banking community as being a fairly burdensome regulatory scheme. 65% said that they rated it as significantly more burdensome than the BSA. Again, we asked them whether or not the rulemakings under the CFPB had affected their business activities, and we see that 71% indicated that it had. We asked whether or not they had added personnel specifically because of the new CFPB rulemakings, and roughly 37% of the sample said that they had indeed hired personnel specifically in response to the CFPB. And again, you see largely that they're adding 1 personnel, but up to 5. And what does that mean for products and services that the banks offer? I'll draw your attention to the lower portion of the chart. You can see those bottom 5 products and services. The blue bars indicate products that they've already discontinued as a result of Dodd-Frank, and the orange bars are products and services that they anticipate discontinuing in response to Dodd-Frank. And again, because of the communities that these small banks serve, and because oftentimes they are either the only bank or one of very few banks serving those communities, a change of 16% in residential mortgage offerings can translate to a much bigger impact. It's not as if there are a multiplicity of banks offering residential mortgages to these local communities. They may be the only bank offering residential mortgages in that community. So we think this is a pretty important and pretty significant change. To understand and make sure that we weren't mistaking the reason for the reductions or the changes in mortgage offerings, that it wasn't the result of the general economic performance of the U.S. or the communities, we asked them to be specific. And as you can see by this chart, most of the changes in mortgage offerings were either the result of specific regulatory requirements that have already passed or in anticipation of future ones. And then to get a little more granularity about what developments were leading to these changes, we asked them again to rank the impact of different developments. And you can see at the top of the chart the CFPB, the definition of qualified mortgage, and the definition of qualified residential mortgages as being the main culprits of the changes to mortgage offerings. Here we asked whether or not they intended to make loans that did not qualify for the definition of qualified mortgage. And it was pretty evenly split into thirds. But I think as Mr. Trabajo will tell you, that is a major area of concern and thought and strategy for small banks, is whether or not they will continue to make loans that don't meet these definitions. How are these changes impacting the bank's earnings? Well, again, if you look at the bottom of this chart, the biggest impact, again, are changes in mortgage regulation, the Consumer Financial Protection Bureau, and debit card interchange fees. And those seem to be drastically affecting the way that the ultimate earnings and income of these banks. And so we asked, how are you going to respond? Do you think this will lead to further merger and acquisition activity in the future? There were a few banks that, since Dodd-Frank, had already engaged in mergers and acquisitions. And then another, about a quarter of the sample said that they intended to in the next 5 years. So what can be done about all of this? Well, as Hester will discuss in just a minute, we think one of the things is do a better job of listening to the banks. We know that the FDIC and the Federal Reserve has been making attempts to reach out to small banks and understand how they're responding to Dodd-Frank. But based on our survey sample, a significant portion, 65%, said that they had not received any contact. And those that had, the most common response was outreach from their state banking regulators. So we think federal regulators can do a better job of reaching out to small banks. I'm going to turn it over to Hester to make a few concluding remarks, but again, thank you all for your time.
Thanks, Ian. So as Ian mentioned, the policy implications are pretty basic. I mean, one is to listen to small banks. And then a second implication is that regulators really should use the tools at their disposal, which include economic analysis to try to understand what the consequences of their rules will be, and if they figure out what problem they're trying to solve with their rules, and they figure out the different ways to solve that problem, and then they think through the costs and benefits of each of the alternatives, we're going to get a better regulation in the end. And then there are also specific tools that are designed to get regulators to think through implications for small entities like small banks. And so that's something that the regulators have not taken as much advantage of as they could, and so we hope that they'll do a better job of that. And then, of course, Dodd-Frank comes on top of a lot of other regulations that have built up over the years, and so there's a lot of room to go back and say, okay, which of these regulations do we really need on the books still, and which can we get rid of? And so we encourage regulators to do that. And then finally, providing longer implementation periods would be very helpful for small banks. On the mortgage rules, we saw small banks calling for more time and meeting pushback. But for a bank that's trying to go through regulations, figure out what they do, how they affect that bank, more time is helpful. And then also, if they're going to seek outside assistance, for example, from consultants, a small bank might find itself at the end of the line. And so it might have to wait before it can get the help. And so we think that allowing the bank a little more time is a small concession to make and would be helpful. But I know you guys want to hear from a banker who's actually experiencing these things, so I'm going to turn it over to Mr. Trabajo.
These are not my notes. Well, good morning. Thank you for inviting me to this meeting. Just as a little bit of background, my name is Ignacio Trabajo. I'm the president and CEO of Commerce Bank in Laredo, Texas. I've been the president there for 32 years. But I have at least 44 years of banking experience. I started in 1970 as a credit analyst in a large bank. So I know a little bit of the difference of being in a large bank and a small bank, but I am a community banker per se. We basically started that bank. I'm also part of a larger organization called the International Bankshares Corporation, which is a $12 billion institution in South Texas. And South Texas meaning Hispanics. Laredo, Texas, where I'm situated, is 97% Hispanic, so I understand the problems that the Hispanics have. And I'm basically going to talk about two things. First of all, I'm going to talk about the general effect of the Dodd-Frank Act on us in a very general, from 30,000 feet up. And then I'm going to talk about one very specific area that I think will be the biggest detriment to the banking community. As you all have seen in some of the charts, when I first started in banking, there were 14,000 banks out there. There are now 6,400 banks. Within that 6,400 banks, 100 banks, or 1.5% of them, control about 80% of all the assets. That's from a tremendous flip-flop from when I first started banking. That means that 98.5% of the banks, or 6,300 banks, control only 19% of the total assets. Keeping in mind that 48% of all the small business loans are made by community banks. Basically, small business loans create jobs and create innovation and creativity. 48% of all those loans are made by us. Obviously, a lot of this happening has been due to mergers, acquisitions, consolidation, failures. There are some bad banks out there that failed. And there's not to say that it will not continue. It certainly will continue. The problem is that not all banks, large banks or regional banks, are interested in smaller community banks. I'll give you an example. Us as a regional bank or Bank of America or Chase, we're not interested in acquiring a small bank in West Texas that is $80 million. There's no growth, and that's the only bank in town, and they're not interested in Fort Stockton, Texas. So they're not going to, that bank is either going to die, or it's going to suffer through a lot of bad examinations, or basically because nobody's going to take them over. The only alternative to those banks is basically to consolidate within a region. Some of the small communities in there consolidate as a bank. Or if it's a family-owned bank, which a lot of them are, they just say, well, I can accept a 5% return on my investment and we'll just live with it because of tradition, family. But as the new generations come into the banking system, they have a different idea. Anyway, the main problem that we have here is that we have now 19,000 pages of Dodd-Frank. 40% of them have been instituted already, and about 60% or about 11,000 pages of regulations will be started. Now, can you imagine a small bank like us, $550 million bank, with 55 employees trying to digest, 19,000 pages? It's almost impossible. Not only is it impossible to digest and understand, but even more impossible to interpret of what they're really trying to say. And I can guarantee you that if you ask the examiner what they want us to do, they don't know. They're as naive as we are when it comes to some of these regulations. They ask the Dallas district for an interpretation. They don't know. And they always send it to Washington for a clearing of what to do on a certain law or regulation. And that will take 6 months to 9 months for the interpretation to come from Washington. So there's no way a small bank can sustain this particular type of expense. It's very difficult to implement and very difficult to interpret. Now, I want you to understand this because within this context, there are basically 4 areas that are very, very difficult for us. First of all, the interest margins have narrowed. We understand that very clearly. The recession, interest rates are low, so the spreads are low. And we make money on the spread. 3-4% is what we like to have. We're at 2.5%, maybe 3%. There's no spread. The current recession and low interest rates have caused this, and the fact that because we are in a recession, there is very low loan demand. We make money on loans. And the only way I can open my spreads up is to increase my loan volume. Now, I have a dilemma here. I have very low loan demand, and the good loans that are out there are taken away from me from the larger banks. Why? Because they have better pricing, they have better products, and I cannot compete sometimes with the larger banks for these large loans that are good. So I have to go to the marginal or medium-sized market to compete for higher loan demand. Secondly, our non-interest income is down. Why is that? Well, let's talk with the Darwin Amendment. The Darwin Amendment created a problem for us because it cut half our interchange fees. Half. Half of them were eliminated because, according to them, they wanted us to break even. And we sure enough, I mean, it was amazing how they calculated this formula that in fact we break even on the interchange fees. But as you all know, who's taking the cost of the Target fiasco? Target, Neiman Marcus. Every month I see fraud in our interchange or our debit card and our cards. We absorb those costs. Guarantee you that. Target has not taken, well, they've taken some losses on their own credit cards, but the losses have been ours because of the Dormant Amendment. So that has restricted our income, our fee, and it was cut in half. The new regulations having to do with, let's say, overdrafts. Now we have to be very, very clear to the consumer as to what causes the overdraft. So when a customer comes to the bank and wants to open an account and we tell them about the overdrafts program, we have to almost sit them by the hand, take them to a screen, and give them a step-by-step situation to understand what are the consequences of overdraft. That has cost us a lot of training and a lot of money. The large banks is another area that we've had a lot of competition. Their products and services are very, very low, and sometimes we have a lot of problems competing with them. And of course, as you all are talking about here, the number 3 area that I'm very concerned about is the non-interest expense. Regulatory compliance expenses, as was mentioned. Ian mentioned that it was a 5% increase. In our shop, it's at least 50% increase in expenses, at least. And we did a different format because we couldn't sustain more expenses on the compliance. We hired a lot of people, so we decided to go by a committee form instead of adding more people. And basically, this is our compliance organizational chart. And it's done by committees. So I'm in about 4 or 5 of these committees. So I spent at least 4 or 5 meetings per month going through regulatory compliance issues. This is Marv Back. Can you see a small bank in Sonora, Texas doing this? No way. This is our people that are involved in there. This is the organizational chart. These are the people, actual people that are involved in these committees. And this is my own bank's, Commerce Bank's organizational chart. Now, so what do we do in these committees? Well, I'll give you just one committee, CRA Executive Committee. Once a month, they produce charts, after charts, after charts, after charts, and we track what's going on in this particular area. The Small Business Loan Committee, another one. This is HMDA coming down the line. We're going to have to track this in many ways, charts after charts, and of course we have to analyze them and interpret them. The Fair Lending Committee, another one that I belong to. Oh, this is very, very difficult to understand because we got regression analysis that we have to do here to understand how many rejections we made, et cetera, et cetera. This was not around 5 years ago. We could not afford to hire 20 people for compliance. So we went ahead, and now senior management is involved on this area so that we can understand what's really happening by some of these people that are producing this information. So anyway, the point I'm trying to make is we have to monitor all this compliance, all this data. We have additional auditors. Oh, and then we have auditors that check this guys, and then the internal auditors check the compliance auditors, and then our outside auditors check those auditors. It is ridiculous how many audits are going around the bank. Then we have now our internal attorney, which has now become an expert in compliance. We have an external attorney, which incidentally costs $1,500 per hour. So when we call them, we very judiciously take only a few minutes of his time because that's how much it costs experts in compliance right here in Washington, D.C. So attorneys make a lot of money on this area. We have now the outside compliance consultants that we bring in to give us the statistical analysis of them. And now we have a huge staff, which we did not have a huge staff on BSA, money laundering. We have 63 people working in our San Antonio office monitoring our customers' accounts. And if you're our customers, we monitor your account. Anything unusual that transpires through that particular account, red flags go up. If we have this young lady that might have a salary of $5,000 per month, she's my daughter, and all of a sudden $100,000 comes into her account, somebody's going to call her up and find out where she got $100,000 in her account. And she better have the right documentation. In our area, the border area, we have a lot of people from Mexico that the old routine, well, I sold my ranch in Mexico. Oh, well, could be. Or something else. So I ask them, I literally have to ask them, bring me legal documentation where you sold that ranch in Mexico and you got $100,000 and it came into the account. Otherwise, it's a CRA, or not CRA, CRA, the Suspicious Activity Report, SAR, Suspicious Activity Report. That's where she goes. And that goes to FINSA in Wisconsin, because they're going to be checking on her social security number, et cetera, et cetera. They're going to be watching her. That takes a lot of time. 63 people doing that stuff. Now, does that contribute anything to my bottom line? Now, you might say, well, we're here to protect the country. Out of the last 10 years we've been sending in stuff to the government, there's been one prosecution. Of the tens of thousands or hundreds of thousands of CTRs, we send daily 10,000 a day, and the SARs, the suspicious activity, one prosecution from the federal government. 63 people taken away from our earnings, taken away from products, taken away from interest rates, taken away from adding capital so we can grow. So this is the kind of cost that they're talking about. And the fourth thing that we have to talk about here is competition from the larger banks. As I said before, good loans are hard to find, but they're very competitive, and I find it very hard to compete with LIBOR rate plus 200. I just don't make money on them, so I let them go. Fees on their products and services are credit unions are tough now because they can do business loans. Some of the credit unions in Texas are much, much bigger than us, but they compete with me. And by the way, they don't pay any taxes. And of course, the non-banking competition, the payday lenders. All of them are competitors. The bottom line is that our profits are being strained. They're decreasing, even though if you look at the overall banking industry, the last fourth quarter of 2013, the banking industry has gone up. I think it's 1%, 1.01% return on assets, which is still low, but better than it was a year ago. The recovery is going on, but not enough. Why? Because now we got Basel III, we got new capital requirements. Most of the banks, according to the FDIC, or at least 85% of all the banks, will be able to absorb the Basel III requirements on capital, but that only says they can absorb them right now without consideration for growth. If you have growth in your bank, you need capital. In today's world, in the regulatory world, capital is king. Just like cash is king, capital is king. And the only way small community banks can sustain themselves is through return earnings and profits. If we don't have those return earnings and profits added to our capital, we cannot grow. Because there's nobody who's going to be interested in investing in a bank in West Texas or in the Brush Country, Hebronville, Texas, Robsville town. Those towns, I don't know how they're going to do it. The point is that we have a lot of headwinds in front of us, and eventually we're all going to survive, but there's going to be a lot of consolidation. The second thing I want to talk about is what is the purpose of community banking and what is it that we do that differentiates us from the large banks, those 100 banks that I was talking about. The difference is that we deal with relationships. I deal with a consumer, with a small businessman, and I know him, and I understand the needs, and I know the community. I don't do it by formulas. I do have credit analysis, and I have all kinds of other stuff. But if a person comes to me and wants the loan, and I have faith in him, and I have trust in him, and he's been banking with me for 20 years, but he has bad credit, I'm still going to make that loan. If this man had a problem with health or had some hospital bills and he couldn't pay, and according to my formula, I would make that loan. I can't do that anymore. Discretion, my discretion of making those loans has been eliminated through this Fair Lending Act and disparate impact type of situations. I cannot make that loan anymore because now he has to fit into my little underwriting criteria in the little box. That's the way the examiners want it. That's the way the regulators want it. They want to make sure that it's consistent because of fair lending, and they want to make sure it's uniform to everybody. Now, you talk to the examiners about this, and they'll tell you, oh, you can make an exception, Mr. Rojas. There's no reason why you can't make an exception. Everybody makes exceptions. Well, that sounds very nice until you make, out of 100 loans, you make 5 exceptions, and they come to you, and you documentate your file, why you made those exceptions, and they ask you, well, you got 5 exceptions here, 5%, that's within region, that's within reasonable. It better not be 20%. It better be 5% of your criteria. But then they start asking you questions like, did you notice that those 5 exceptions are all males? Where are the females in these 5 exceptions? So now I have to make another adjustment to my exceptions. So the best thing for me to do, and what most banks are doing, are saying, we're not going to make exceptions. And what does that mean? It means that I'm refusing and rejecting an awful lot of loans that I did not reject 5 years ago. It's just going to be very, very difficult for me. And within our community, Laredo, Texas, there's a lot of idiosyncrasies and a lot of local things that we do. For instance, in Laredo, Texas, it's a cash society. Why? Because a Mexican person comes from Mexico, buys a TV or 10 TVs. They're not going to take a check from Mexico, this retailer. They do it with cash. They pay $1,000 cash. So our community, there's a lot of transactions. If you don't understand how to deal with cash, and you don't understand how the businessman deals with that, you're going to have a problem. Now, so what I'm trying to say is that the problem is that the examiners are looking for consistency and the one-size-fits-all type of situation. It makes it easier for them. And actually, this is the way all large banks have been doing it for years and years. You send in your computer application, it's accepted or rejected, and that's the end of the story. They want us to do the same thing. Why? Because it's easier for them, and it's easier for fair lending, and it's easier for everybody. So this one-size-fits-all is very, very critical to us, to me, as a banker, doing business in a small community. I have to apply this to consumer lending, to the mortgage lending, and pretty soon to the small business loans. Now, how do I put an idea into a box? If my daughter comes in and she wants a $10,000 or $20,000 or $100,000 loan to open a restaurant, and I believe that she's determined, but she doesn't have the credit, she doesn't have the down payment, she doesn't have whatever, under the normal circumstances, she's going to be rejected. How do I put an idea into a box? I don't know. But the Dodd-Frank says I'm going to have to monitor small business loans under the same format as HMDA. So I don't see how we're going to do it. In other words, no discretion, no relationship banking, no community banking. That's what I see. And I already discussed that we're not going to make any exceptions. We just don't like the risk. It's too high. We definitely don't want to go and be referred by the examiners to the Department of Justice. That is now big time bad stuff. You cannot fight DOJ. The banks that have fought DOJ in Texas have lost and spent hundreds of thousands of dollars fighting them. You don't fight I don't know how many attorneys they have, 5,000 attorneys over there. So what are banks doing? They're just not deviating. They're just going strictly by the book. And of course, like I said, our biggest advantage is discretion. Our biggest advantage is relationship banking. We all have the same products and same services. How can I compete with the larger banks? I don't know. So again, the regulators want and encourage and insist on standard products and services, including consumer, mortgages, small business, and that will kill the banks. The sad thing about this, of course, is instead of helping the unbanked, the underbanked, the protective classes, I'm hurting them. That's the way I see it. Because I can give you example after example of a person that I would have made that loan that did not fit, that has been rejected. And I tell them, sorry, can't help you. Go down the street to the payday lender. And that's what they're doing. Because they also will not qualify at the big bank. I guarantee you that. So, the rejection rate, now we track all that. We never used to track rejections and approvals. And I'm ashamed to tell you how much we're rejecting, but it's a big number. Anyway, because there will be lesser true community banks, small enough to be true relationship banking, many unbanked, underbanked, and protected classes will suffer. And at the end of the day, the mere people that are trying to protect are the same people that are being hurt by all this. So, thank you very much.